So these are the ways of reducing agency conflicts between the shareholders and the management. So the last one is application of good corporate governance principles. Application of good corporate governance principle that will tell them how they should be able to manage the company. Now, when we talk about good corporate governance principles, we are talking about accountability. We are talking about public participation. We are talking about integrity. Those are good corporate governance, the principles that people should follow when they are running an office or an organization. So, application of good corporate governance principle, when instilled on the employees, they will be able to know the importance of accountability, integrity, and such like things. Now, let's look at the agency relationship between shareholders and creditors. Agency relationship between shareholders and creditors. Agency relationship between shareholders and creditors. So you write and say that the debt providers may, you can say that creditors are providers or lenders of long-term debts. Creditors are providers and lenders, or lenders. Creditors are providers or lenders of long-term debts. They usually give capital to the firm. 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 Creditors are providers or lenders of long-term debt capital. They will usually give capital to the firm. They will usually give capital to the firm. Of course, the reason why they give capital to the firm, we know. Number one is to strengthen the existing capital structure, to strengthen the expected capital structure. You know, so we are saying that an agency problem, proceed. An agency problem, proceed. An agency problem or conflict of interest exists. An agency problem exists between the creditors and the shareholders. Between the creditors and the shareholders. Now, so we are saying that agency problem or conflict of interest between the creditors and the shareholders will arise when the shareholders take action. It will arise. I'm trying to explain to you how it can happen. So in exam, if they ask you how does it exist, you can explain when the shareholders take action which will reduce the market value of the bond. Remember, bond are debentures. Debentures, bonds, and loans are the same. So these guys, they normally give us the bond or debentures, the creditors. But the shareholders can decide whatever loan they are given in the form of bond or debenture, they can take actions that can reduce the value of that bond. And that can be a problem to the lenders, because lenders are not directly involved in the management. These are people who have just given you the money, you go and manage. Wewe ukienda pale unaanza misuse. So we are saying that it can arise when the shareholders take action which will reduce the value of the bond, and by extension, the wealth of the bondholders or creditors. And by extension, it reduces the wealth of the creditors. And by extension, it reduces the wealth of the creditors. And by extension, it reduces the wealth of the creditors. Now, how to reduce this? Resolution of conflicts. Resolution of such conflicts. Say resolution of conflicts. These conflicts. Resolution of conflicts. Number one, restrictive covenant. Restrictive covenant. Covenant are the agreement or contract. Remember in the Bible, we had a covenant that existed that Moses took, right? Moses picked. That one is a covenant. Now, that agreement is also there between the shareholders and the creditors. So we are saying that to reduce the conflicts, number one, we should have restrictive conflicts where the debt holders might impose. You say, explain. You say that the debt holders might impose a strict terms and conditions on the borrowers. They might impose a strict terms and conditions on the borrowers. One of the conditions that they might impose is that there is no disposal of assets used as collateral for the debt. One of the conditions that they might impose include no disposal of assets used as collateral for the debt. No disposal of assets used as collateral for the debt. That is one condition that they can give. Very restrictive. Means that whenever we are giving loan, some loans are called secured, some are unsecured. Listen, we normally have types of loans. Those loans, we also call them bond or debentures. When you give them, it can be secured or unsecured. So the one that we normally get without giving any security is called unsecured. The ones that we normally have security to protect an item that has been attached on it is called unsecured. It's called secured. Like ukichukua loan, they can take title deed or logbook. Those are secured loan. That item is called security or collateral. Now, the debt holders, the creditors might have a strict condition that we are giving you loan, but the item that we have used as security or collateral that has been taken as security cannot be disposed. Whatever asset that we have taken as collateral cannot be disposed. The next one, no payment of dividends from retained earnings. That is a condition that they can give. No payment of dividends from retained earnings. So normally when management gets profit, the shareholders always get part of the profit in the form of dividends. But now when they do that, the company will have less funds or less liquidity. So the debt holder can say that even if you make profit, please don't share. Make sure that you retain it so that the company becomes stable. Because if you share amongst yourself, the company will have challenges. So they can restrict that there is no payment of dividends. That is another restriction. They can also say that maintenance of given level of liquidity, they can specify the level of liquidity that must be maintained by the company. That is another condition. Yesterday we talked about liquidity. You guys remember what liquidity means, eh? Maintenance of a given level of liquidity. Maintenance of a given level of liquidity. So they can say that at every given time, you guys might be having money. Remember what we said. We said that liquidity is the ability of the company to pay its obligation when they are due. One of the obligations is loan. When the debt to pay loan imefika, the company should be having the ability to pay. And the loan holders or debt holders are interested in the company having money. They want the company to always have some liquid cash that they can be able to pay whenever they are due. That is why they can restrict that at some point, you need to be having, at any given point, you need to be having such liquidity. The next one, restrictions on mergers and takeovers. Restriction of mergers and takeovers. Restriction on mergers and takeovers. Restrictions on mergers and takeovers. Restriction on mergers and takeovers. Restriction on mergers and takeovers. The next one, no borrowing of additional capital or funds, no borrowing of more debt, because if you borrow more, you'll not be able to pay. No borrowing of additional funds or capital. They might also specify the type of debt to be taken, the type of projects to be taken. The debt holders might also recommend the type of projects to be undertaken. They might also recommend the type of projects to be undertaken. They might recommend the type of projects to be undertaken. Now, let's look at the next one. It's called callability provision. That is number 2. This is number 1. So we have number 2 here, callability provision. That is number 2, callability provision. Number 2 is callability provision. So you say that this provision will provide that the borrowers will have to pay debt before the expiry of the maturity period. So the word call, it means that if I give you my money, I can decide anytime to take it back. We are going to use site knowledge as we proceed. To call, it means that kuitisha, right? So if I'm a debt holder, I've given you my money. Even if we agree that you'll pay me after 1 year, we have to have a provision in our agreement that anytime I want my money, I can call it back and you pay. What is the implication of that? It means that at any given time, you should be having liquid money, such that whenever I call for my funds to be brought, you bring it. So that is the callability provision. That provision should state that we have the right to call for our money at any given time. So I hope that you understand. You can now write that this provision will provide that the borrower will have to pay the debt before the expiry of the maturity period if there is breach of contracts, if there is a breach of terms and conditions of the contract. It provides that the borrower will have to pay in case there is breach of in terms of conditions of contract. The next part, I hope that that one is okay. You have written it. You've written it. We can proceed. The next one is transfer of assets. Transfer of assets. Of course, we know that there are some assets that were used as security to protect the loan, right? Those assets that have been used as security to protect the loans can be transferred to the name of the debt holders anytime. So we are saying that the bondholder or lenders might demand the debt holders or lenders, that is number 3, transfer of assets, right? The debt holders may demand the transfer of asset to him on giving debt or loan to the company. So they can demand that I'm giving you loan, but you have to transfer the asset to me. I've seen this one being used by many companies like Shylocks. When Shylocks give money, they normally take something as security. And as a chukua title deed, and as a kana you gari physically, anything can happen, right? Their main aim is that in case you default, they will have something that they don't need to follow. They will have it already. So transfer the assets. We are saying that the debt holders might give a condition that they might demand transfer of the asset to him or her on giving debt or loan to the company. However, the borrower will maintain the possession of the asset. The borrower will retain the possession of the asset and the right of utilization. So, like motor vehicle, you will transfer the title deed, but the motor vehicle still remain with that person. He's still using it, but he's not the owner. The next one, you can say that the completion of repayment of the loan, the asset used as collateral can be transferred back to the borrower. On completion of the loan, the asset used can be transferred back to the borrower. The next one is convertibility. That is number 4. convertibility, convertibility, convertibility. Then you say, on breach of bond covenants, 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 the lender may have the right to convert the bonds into ordinary shares. On breach of bond covenants, 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 the lender on breach of bond covenants, the lender might have the right, the lender may have the right to convert the bonds into ordinary shares. The lender might have the rights to convert the bonds into ordinary shares. The next one is refusal to lend or refuse to lend. They can refuse to lend. That is another way of sorting the issue. Just deny them. Refuse to lend. Refuse to lend, then you say that if the borrowing company has been involved in an ethical practice, if the borrowing company has been involved in unethical practices associated with the debt capital borrowed, the lender might withhold the debt. If the borrowing company has been involved in unethical practices, if the borrowing company has been involved in unethical practices, the lending company might withhold the debt capital so that, or hence, the borrowing firm might not meet its investment needs. So that the borrowing company might not meet its investment need. The next one is called a representation. A representation, that is number 6, a representation. Now, when you're doing business with the companies abroad, when you're doing business with companies international, what happens is that sometimes those companies might have a guarantee letter from the bank, your bank. So your bank can write a letter to the company in US confirming that you are worth doing business with them. You are creditworthy. So in case you default, the bank inasimamia. That is a representative. So we are saying that the same way, some lenders might employ this technique. So you say, under representation, you say, the lender or bondholder may demand to have a representative in the board of directors. In this case, with them, they want somebody to be part of the board of directors on the other side of the borrower to oversee how the funds are being utilized. The lenders or the bondholders may demand to have a representative in the board of directors of the borrower to oversee how the funds are being utilized. To oversee how the funds are being utilized. Let's look at agency problems between the shareholders and the government. Agency problems between the shareholder and the government. Shareholder and the government. Agency problems between the shareholders and the government. You can say shareholders and the company must operate within the environment using the license granted by the government. The shareholders and the company must operate within the environment. The shareholders and the company must operate within the environment. The shareholders and the company must operate within the environment. They must operate within the environment using the licenses provided by the government. Full stop. The government expects the company to operate in ethical manner which benefits the entire economy and the society. The government will expect the company to operate in a very ethical manner that benefits the economy and the society. That benefits the society. The government has a responsibility to provide a conducive working environment. The government provides a conducive working environment for the company. The government provides conducive working environment for the company and expect to share in the profits of the company through taxes. And expect to share through profits of the company through taxes. So where is the conflict coming from here? Let's look at the causes of conflicts. Causes of conflicts. The government needs to give you a good environment to work. You also need to pay tax. Very simple. Shida inatokea wapi? Causes of conflicts. Number one, tax evasion or tax evasion. You guys need to know there are differences between tax avoidance and tax evasion. This word came from a verb, kuhepa. Avoid is from to reduce. So this one is legal. This one is accepted. Tax avoidance is expected, and you have to avoid it or reduce it in a legal way. But to evade is illegal. Now, when a company decides to evade tax, it's called tax evasion or evasion. That is a problem. So you say that this involves the failure to give accurate picture of the firm's profit. This involves failure to provide accurate picture of the firm's profit. It involves failure to give accurate picture of the firm's profit. And did we write the causes of conflict between the creditors and the shareholders? You can write notes somewhere and include that, causes of conflicts between shareholders and creditors. Kama tu kuandika, tuliandika. Did we write that? Causes of conflicts between the shareholders and creditors. Please check. One of the causes of conflicts between creditors and shareholders, you can write some note somewhere, is disposal of assets used as collateral that cause conflicts. Number two, payment of high dividends. Payment of high dividends, that can also be a challenge. When they are paying high dividends, can cause conflicts. under investment, under investments, under investment can cause conflicts. Under investment can cause conflicts. Under investment can cause conflicts. Borrowing more debts can also cause conflicts. Borrowing more debts can cause conflicts. So here, we are now looking at the causes of conflict between the government and the shareholders. One of them is tax evasion, where the company is not declaring the exact tax amount because their main aim is not to pay tax. Company is not declaring the exact or the correct tax amount to reduce tax. That is a problem. Number two, involvement in legal business activities. When the company is now involved in illegal business activities. You remember when I was teaching you audit, I said that you need to have a good understanding of the client because the client could be involved in a bad business and you're the auditor. You will be asked, did you see that? Did you realize that? So when a company has been given license to operate, they need to operate in a legit business. So illegal business activities are not allowed. Involvement in illegal business activities. Involvement in illegal business activities that can cause conflicts between them. That can bring conflicts between them. Lukewarm responses. Lukewarm responses. Lukewarm responses. Lukewarm responses to social responsibility calls by the government. They don't want to get involved in social responsibility calls. Lukewarm responses to social responsibility calls by the government. Lukewarm responses to social responsibility calls by the government. Remember yesterday we said that one of the responsibilities of the company is the CSR, the corporate social responsibility. That is one of the objectives of, which is also non-financial objective of the firm, CSR. Now, when the government calls companies to get involved in social responsibilities, now unaingiza baridi, then they don't feel well. The next one, lack of adequate interest in the safety of the employees. Lack of adequate interest. Interest on the safety of the employees. Lack of adequate interest on the safety of employees. Lack of adequate interest on the safety of employees. Lack of adequate interest on the safety of employees. And also the product and services of the company. So if the company is producing products that are not safe, for example, you are in the production process, you are emitting some waste materials that are harmful, or the products are not very safe for consumption or for use, or the physical environment of work is not good, that can also bring issues. The next one, avoiding certain types and areas of investment coveted by the government or designated by the government. Avoiding certain types of investment, avoiding certain types of investment, avoiding certain types of investment designated by the government. avoiding certain types of investment designated by the government. That can also be a problem. Let's look at the solution of this agency problem between the government and the shareholders. Solution of agency problems. The last point I say that avoiding certain investment that have been designated by the government. The government has told you to do investment in certain areas, but you are trying to avoid. The government will feel like you are not doing your responsibilities or you are not complying. Let's look at resolution to agency problem here between the two. Agency problem between them. Number one, obviously we know you need to pay your taxes well. So in car, the first one we can talk about incur monitoring cost. The government can decide to incur monitoring cost to check on how you are filing tax, paying VAT, and such like things. So the government can incur monitoring cost. That is number one. Associated with statutory audit, investigation of companies, investigation of the companies under Company Act, back duty investigation cost to recover tax evaded in the past. Back duty is the same as additional assessment. When the government realizes that you have not paid tax as expected, they can come later to investigate the taxes that were not paid. So that additional assessment is called back duty. So we are saying the government can reduce this cost by deciding that we are going to incur the cost. They can reduce the conflict by agreeing that they are going to incur the cost. The first cost, they can have it compulsory that statutory audit must be done, and they come and check whether you've done it. Number two, they can check whether you are complying with the Company Acts. Number three, they can perform back duty investigation so that they can recover the taxes that you evaded. Back duty investigation to recover tax evaded in the past. They can also do for you VAT refund. In case the issue was taxes that you are overtaxed, they can refund you. So they can do VAT refund. The next one, the government can also offer investment incentives. Investment incentives. Offering investment incentives to the companies so that they can support you to do whatever they want. Like if you are to invest in certain areas and you are fearing, they can give you incentives to do that. They can pass legislation to provide legal framework of operation. The government can provide legislation for framework of operation. So check your notes. After VAT, the second point was offering investments. So that offering investment is the second one after this. The first one was incurring monitoring cost. Incurring monitoring cost. And I talk about them. The next one now, offering. So let this be number two, offering investment incentives. Offering investment incentives. Number three, I talked about what? Legislation, passing legislations, passing legislation to give or provide legal framework on how the operation should be done. The next one is lobbying for directorship or representative. Lobbying for directorship or representative. So where the government feels like they have interest, they might want to appoint their director there, so they can have somebody. The next one is lobbying for representatives. I want us now to look at agency relationship between shareholders and directors. Agency relationship, not directors, but auditors. Shareholders and auditors. Agency relationship between shareholders and auditors. Agency relationship between shareholders and auditors. So you can say that shareholders appoint auditors as per the provisions of the Companies Act. Shareholders appoint auditors. Shareholders appoint auditors. Shareholders appoint auditors as per the provision of the Companies Act. The auditors are supposed to perform their work on behalf of the shareholders. The auditors are supposed to perform their work on behalf of the shareholders. They act as watchdogs. They act as watchdogs. They act as watchdogs. They act as watchdogs. They act as watchdogs to ensure that the financial statement prepared by the company reflect true and fair view. They act as watchdogs to ensure that the financial statements presented by the company reflect free and fair view, position of the company. Reflects free and fair view, position of the company. Reflects free and fair view, position of the company. However, the auditors may prejudice. The auditors may prejudice. The auditors may prejudice. However, the auditors might prejudice. However, the auditors might prejudice the interests of the shareholders, hence causing agency problems. Hence causing agency problems. So let's look at the conflicts, causes of conflicts. Causes of conflicts. Causes of conflicts between the auditor. The auditor can prejudice their interest, the interest of the company. Number one, what causes the conflict? Number one is colluding with management when performing their duties. So the auditor can find that the management has done some mistake. Instead of telling them the truth, he can collude with them so that they hide some information. That can actually be bad to the eyes of the shareholders when they hide mistakes of the management. So colluding with management. Number two, demanding high audit fee. Demanding high audit fee. Demanding high audit fee, which reduces the company's profit. Issuing misleading reports. Issuing misleading report. For example, they can say that the company is doing well when the company is not doing well. Giving misleading report can also be a challenge. Issuing misleading report can also be a challenge. And then the last one, failure to ensure professional due care. Failing to ensure professional care and due diligence or professional due care. You see, auditors have a responsibility. I'll teach you that as we proceed with audit, you as a unit, auditors have got a responsibility to ensure that at any given time, the report that they're giving can be supported. These are the facts on the ground. If the auditor is giving wrong conclusion, then they are causing something called audit risk. When you're giving wrong conclusion, you are causing audit risk. So this one is the risk that the auditor is giving a wrong conclusion. Audit risk is the risk that the auditor is giving wrong conclusion. Now, the auditor can have a problem with shareholders whenever they are giving wrong conclusion. An example of wrong conclusion could be they are saying that the financial statements are true and fair when they know it is not true and fair. That is a wrong conclusion. So we are saying, in that case, they have failed to ensure professional care. They have failed to ensure professional care and due diligence when they are performing their duty. They were not careful. They lied to us. So therefore, that can be a problem. So failure to apply professional care and due diligence. Let's look at the solution to the conflicts. How do we solve conflicts between the auditor and the shareholders? Resolution or solution to the conflicts? Solution to conflicts between auditors and shareholders. We have seen ways in which they can cause conflicts. Number one, colluding with management. Number two, giving wrong conclusion. Number three, high audit fee. We have seen those ones. And then number four, we talked about being lazy, not ensuring due diligence, failure to ensure due diligence. Solution to this. Number one, rotation of auditors. So you can have auditor for 3 years, then another one comes in, another one comes in. You don't stick with one auditor forever. Because if you have one auditor forever, they will get used to the management, they will always collude and hide things, then nobody will be able to show. If you bring a new auditor, kabla wajuane waelewane, watakuwa washalipua the story, right? There is anything that is being hidden. So you say, the first one, you say, rotation contract. You can also take legal action number 2. Take legal action. The first one is the rotation contract. Number 2, legal action. Legal action. Legal action. Legal actions. Take legal action against the auditor. Rotate auditors. Have contract which you rotate auditors. Number 3, disciplinary actions. Disciplinary actions. Disciplinary actions. Disciplinary actions. Where ISPAC can take action against them. One of the actions that ISPAC can take against auditors, disciplinary action that ISPAC can take against auditors, like number 1, disciplinary action that they can take. Number 1, the ISPAC can decide to suspend the auditor. Suspension. ISPAC can decide to suspend auditor. They can withdraw practicing license. They can withdraw practicing license. That is a disciplinary action. Fine and penalties. Fine and penalties. Reprimand. Reprimand. So those are some of the actions that they can take. Another solution, which is number 4, is use of audit committees and audit reviews. Use of audit committees and audit reviews. Use of audit committees and audit reviews. Let's look at the challenges between parent company and subsidiary. Conflicts between parent company, agency problem between parent company and intermediary or subsidiary. Parent company and subsidiary. So we are saying that you can say that multinational companies have diverse corporation setup. Multinational companies have got diverse corporations set up in different geographical locations. In different geographical locations. In different geographical locations. Then you proceed and say that the subsidiary management may pursue its own goals, causing conflicts. Multinational corporations have diverse corporation setups in different geographical locations, full stop. The subsidiary management may pursue its own goals. The subsidiary or branch management might pursue their own goals. May pursue its own goals, causing conflicts of interest with the parent company. Causing conflicts of interest with the current company. Causing conflict of interest with the parent company. So whenever you realize that a company is operating in Uganda and the parent is in Kenya, they are not using the policies and the goals. They are not trying to achieve the goals of the parent. They are doing their own things. Of course, that will cause conflicts. So how do we resolve that? Solution of conflicts. Number 1, frequent transfer of managers. You change the managers frequently. Frequent transfer of managers. Frequent transfer of managers. Frequent transfer of managers. Adopting global strategic planning. Adopting global strategic planning that is acceptable globally. Adopting global strategic planning to ensure commonality of vision. To ensure commonality of vision. To ensure commonality of vision. To ensure commonalities of vision. To ensure commonality of vision. Having voluntary code of ethical practices to guide the branch managers. Having voluntary code of ethical practices having voluntary code of ethical practices, having voluntary code of ethical practices, having voluntary code of ethical practices, and to guide branch managers, to guide branch managers, to guide branch managers, having voluntary code of practices, to guide branch managers, to guide branch managers. The next one, putting in place an elaborate performance reporting system, putting in place an elaborate, 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 putting in place an elaborate performance reporting system to provide a two-way feedback mechanism, to provide a two-way feedback mechanism, putting in place an elaborate reporting system to provide two-way feedback mechanism so that we can know what is happening in both sides. All right. Then the last one, performance contract with managers. Performance contract with managers. Performance contract with managers. Performance contract with managers. So when you talk about performance contract with managers, how do you know that the manager is performing well? You use two criteria. So you use either effectiveness and efficiency. Use effectiveness and efficiency to measure the performance contract or performance of management. Performance of the management. Let's look at corporate governance. Corporate governance. Corporate governance. Corporate governance. And I want to write, say, that this refers to the manner in which directors are leading and controlling the company. Corporate governance refers to the manner in which directors are leading and controlling the company. It refers to the manner in which directors are leading, and controlling the company with the objective of maintaining and increasing the value of the firm. Corporate governance refers to the manner in which the directors are leading and controlling the company, the manner in which the directors are controlling and leading the company with the objective of maintaining and increasing the value of the firm. With the objective of maintaining and increasing the value of the firm. With the objective of maintaining and increasing, with the objective of maintaining and increasing the value of the firm and the interest of other stakeholders. And the interest of other stakeholders. And the interest of other stakeholders. Objectives of corporate governance. Objectives of corporate governance. That is another subtopic. Objectives of corporate governance. Number one, to ensure that proper management and management structures are in place and are functioning. The objective of corporate governance is to ensure 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 that the proper management and management structures are in place and are functioning. Proper management and management structures are in place and functioning. They are in place and functioning. Number two, to ensure that the right people make decisions. To ensure that the right people make decisions. That is why we are saying that one of the principles of corporate governance is public participation. Now, if, for example, you are in the public sector, then you need to ensure corporate governance. Principles of corporate governance expect you to involve the public in management so that they also help you in making decisions. One of the county governments that I've seen are well managed is Homa Bay County. The governor has decided that when they are giving CDF, it is the wananchi who gives the name. So they go back to their local areas, give the name of the people they think deserve the money. So they get involved. The right people get engaged and make decisions. So we are saying that it ensures that the right people make decisions. Number three, to find an appropriate mechanism for governing various groups within the organization. To find an appropriate mechanism, to find an appropriate mechanism, to find an appropriate mechanism for governing various groups within the organization. To find an appropriate mechanism, to find an appropriate mechanism for governing, to find an appropriate mechanism for governing various groups within the organization. Number four, to find an appropriate mechanism for governing various groups within the organization. Number four, to ensure that companies are socially responsible. 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 That is number four. Number five, to reduce the agency conflicts within the company. And we have seen the agency conflicts. So to reduce them, we need to have good corporate governance. To reduce the agency conflicts within the company. To reduce agency conflicts within the company. To reduce agency conflicts within the company. To reduce agency conflicts within the company. Reduce agency conflicts within the company. To reduce agency conflicts within the company. The next one, to ensure that individuals are held accountable for their actions. To ensure that individuals are held accountable for their actions. To ensure that individuals are held accountable for their actions. To ensure that individuals are held accountable for their actions. To ensure that individuals are held accountable for their actions. To ensure that individuals are held accountable for their actions. Let's look at reasons for corporate governance. Reasons for corporate governance. Reasons for corporate governance. Number one, increased number of corporate failure. Increased number of corporate failure. That can be one of the reasons for corporate governance. Increased number of corporate failures. Increased number of corporate failures, i.e., when we are having companies like sugarcane companies going down, that is a corporate failure. we need to ensure that there is a good corporate governance. If the government has realized that, they need to rethink their strategies of managing. And of course, we have seen one of the strategies is not to sell it, but to involve the people, change the management, and such like things, right? So one of the reasons why we need corporate governance is because of the increased number of corporate failures. Number two, increased fraud and corruption behaviors. Corrupt behavior, sorry. Increased fraud and corrupt behaviors. Increased fraudulent and corrupt behaviors. A lot of fraud are happening. Why? Because we lack integrity and accountability. And that is the principles of corporate governance, right? Increased fraud and corrupt behaviors. Number three, growing demand by stakeholders for transparency and accountability. Growing demand for transparency and accountability. Growing demand for transparency and accountability. Growing demand by stakeholders for transparency and accountability. Growing demands by stakeholders for transparency and accountability. Growing demands for accountability and transparency. Growing demands for transparency and accountability. Growing demands for transparency and accountability. Growing demands for transparency and accountability. When people are now demanding for transparency, then we have to employ the corporate governance. I want us now to look at measurement or measuring management performance, compensation, and incentives. We have like 15 to 20 minutes and we are done with that topic, with topic number 1. In our next class, we shall start topic number 2. So hakuna kurudi nyuma, tunaendelea hivyo. Sawa. Measuring managerial performance, compensation, and incentives. Measuring managerial performance, compensation, and incentives. So we can say that the manager's performance can be measured by looking at 2 criteria. Manager's performance can be measured. Manager's performance can be measured. Manager's performance can be measured by looking at 2 criteria. That is effectiveness and efficiency. That is effectiveness and efficiency. That is effectiveness and efficiency. We proceed. Effectiveness is achieved. Effectiveness is achieved when the organization pursues the appropriate goal. Effectiveness is achieved when the organization pursues the appropriate goals, while efficiency is achieved when using the fewest inputs to generate a given output. I'll teach you that again in audit. When we shall be doing audit, I'll teach you about the 4 E's, the 3 E's of value for money audit. When we shall be talking about value for money audit, there are 3 E's. The first E is economy. Then we have efficiency and effectiveness. If you want to check that your money is getting value, you look at the 3 E's. They are called 3 E's of value for money audit. And so we are saying that when we want to measure the effectiveness, how the managements are performing, then we need to look at 2 key things. Number 1 is the efficiency and also the effectiveness. And we are saying that those are the criteria of measuring performance of the management. And we are saying that measuring the effectiveness or effectiveness is normally achieved. Effectiveness is normally achieved when the organization pursue the appropriate goal. When you are looking at the goals, the right direction, we are saying you are effective. An effective governor, we can see there are good medicals, right? We have good roads, we have good education systems or good education facilities, we have good water system. You know, those are relevant goals. Those governors that are not effective, you don't even know what they're doing. You cannot see. They are now focusing on compensating the MCAs. They are giving MPS some allowances. They are going out on trips. You know, MCA who is a Form 4 leaver. How can you take a Form 4 leaver to go to Dubai for benchmarking? What is it going to learn? Those are not the priority. We are saying they are not appropriate goals. Taking an MCA to Congo, to Tanzania, to Uganda for benchmarking. These people are from 4, they don't understand anything like financial management. They have never been in this class. These people have never done any development concept. So even if they go and learn, they come back, so we are saying effectiveness can be seen by how the governance or the management are pursuing their appropriate goals. And efficiency is achieved by using the little capital or the lowest cost of production. If you are saying that your car is efficient, your car is efficient because of maintenance cost is very low, right? If the maintenance cost, the running cost is very low, then that is a very efficient car, right? So we are saying that effectiveness is about pursuing the appropriate goals, while efficiency is about achieving the target by using the fewest inputs, So therefore we can say, proceed and say, effectiveness can be seen as doing the right things. Effectiveness can be seen as doing the right things, while efficiency can be seen as doing things right. Efficiency is about doing things right, but effectiveness is about doing the right thing. So for us to do this, we can be able to motivate employees or managers by giving them some incentives or compensation to make sure that we have or we remain with a high quality managers, right? For us to remain with high quality managers, we need to compensate them. So we have different ways of compensation. We can be giving bonuses. We can be giving trainings. We can be rewarding them with salary increment. You know, if they are governance, we can be giving them another term. Let's look at the forms of bonuses that we can give. Say forms of bonuses. I'm mentioning this because kuna mahali tutatumia in our next subsequent classes. Talk about forms of bonuses. Then you say, bonuses vary from one organization to the other. 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 And payments can be made in. They vary from one organization to the other. And payments can be made in. They vary from one organization to the other. And payments can be made in. Cash or shares of the company. You can give them bonus in terms of cash, or you give them shares. Cash or shares Number 2, stock option. Stock options. Number 3, performance shares. Performance shares. Performance shares. And lastly, stock appreciation rights. Stock appreciation rights. We are almost to the end. Let's look at the last part, which is the ethical issues in financial management. Ethical issues on financial management. Ethical issues on financial management. One of them, human resource development. Human resource development. That is an ethical issue. So we are saying that in financial management, employees are not simply a factor of production. Employees are not simply a factor of production. Employees are human beings and they have feelings. They are also human beings and they have feelings and should be treated by employers with respect and dignity. So ethical things comes in when we have different financial objectives that cannot be met. You are mistreating employees. You're making them work hard, work extra hours, but you're not caring about their welfare. So in that case, you are mistreating them. You are not paying them well. So we are saying ethical problem arises where there is a conflict between the financial objective of the firm and the rights of the employees. The rights of the employees and the financial objectives. I've seen firms where employees are working without protective gears. Unaweza kuwa unafanya kwa factory, hauna hata gumboots, hauna aprons, but you're working there. Hauna zile kofia wanavanga, zile helmets, but you're working there. So we are saying those are ethical issues. You have so much focused on finances, but you are not focusing on the management. So we are saying that ethical issues arises when there are conflicts between the two. The next one, marketing. We also have ethical issues on marketing. Marketing. So marketing is a way of communicating with the customers, right? Or potential customers. And it should be truthful. We have seen organizations, we have seen colleges marketing things that they don't offer. They can't deliver. So when you are outside, they talk too much. Ukiingia, there is nothing. They don't deliver that. So we are saying that marketing should be truthful. It is a very sensitive issue. It's a very sensitive issue that should be looked into. It's a very sensitive issue that should be looked into. So that they are not misled, yeah? Customers are not misled. So we are saying that marketing strategy should not target vulnerable groups. Marketing strategies should not target vulnerable groups. They should not target vulnerable groups. They should not target vulnerable groups. They should not use vulnerable or target vulnerable groups. Create artificial ones and reinforce consumeration. They should not create artificial ones and they should not create artificial ones. They should not target create artificial ones and create or reinforce consumerism and reinforce consumerism. Okay. So let's look at another one is marketing behavior. I think that one is almost the same. Let's look at ethical frameworks. Ethical frameworks. That is the last area under ethical frameworks. Sorry for that. Under marketing, we have done human resource development, and we say that you need to treat human being well. Marketing, we talked about it, and then marketing behavior. So have number 3, marketing behavior, and then you say just write a line and say, before we go to the ethical framework, which is the last, say that under marketing behavior, say that companies should strive to use ethical means to develop new products. Companies should strive. Companies should strive. Companies should strive to use ethical means to develop new products. For example, more and more cosmetic companies are not resting on animals. For example, more and more companies are not resting on animals, an idea pioneered by some companies. For example, more and more cosmetic companies are not resting on animals, an idea pioneered by some companies. So we are saying that the way companies market is also very important. You need to develop products. Companies should strive to use ethical means to develop products. Don't produce products that can actually interfere with animals or even human beings. So let's look at ethical framework. So the ethical framework are basically the philosophies that corporates should always adhere to enhance their corporate governance. So ethical frameworks include economic responsibility. We'll just state them, ethical framework. What should guide companies? Number 1, economic responsibility. Economic responsibility. Number 2, legal responsibility. legal responsibility. We have ethical responsibility. Legal responsibility, and then philanthropic responsibility. Philanthropic responsibility. So those are ethical responsibilities. So we shall stop there. That is the end. We also have whistleblowers' rights. I hope that you know who is a whistleblower. So let's stop there. In our next class, we shall start topic number 2, that is financing decision. And we hope that all will be well. Financing decision. Any question? Make sure that you don't miss whenever we say that there is a class. At least come so that we can move on. The syllabus is quite wide and we need to have more time. Thank you so much. Have a good evening.